morning, everybody. It's Thursday, April 4th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Quickly here, overnight markets had May corn down 1 1.25 at 430.5. May soybeans were down 6 3/4, 1175.5, and May Chicago wheat was down 1/4, 555 3/4. USDA announced weekly export sales out here this morning. Another solid week for corn, 948,000, which was in line with estimates, and they sold just a little bit of new crop 24. Soybeans was below the low end of the estimates, 194,200. Wheat was 16,100 for 23 and 262,000 for 24. Meal sales came back at 202,200. We also had an export sales announcement this morning. 152,404 soybeans to Mexico, and that was for 23-24. Good morning, fellas. Hope everybody's doing well. Dustin, we talked a little bit this morning before we got on just about, you've referenced purchasing power here, for a few shows, and had some questions yesterday just in terms of like what the overall picture and what that means. I thought you spelled it out pretty good just in terms of what has to become potentially a new equilibrium here for price action as we go forward based on, a lot of factors here, including certainly the outside markets.
Yeah, thanks, Dan. Yeah, so I would say just a caveat before we get into like why that might be underlying a friendly tone. I mean, when we have an excess supply, it just doesn't matter, right? The market needs to find the buyers. And I'll point to crude oil, when it went negative back in 2020, right? We got into an oversupply situation. That's a very unique product because you can't just throw it on the ground, right? It ran out of storage, and that's why it went negative. But the concept's the same, which is there's just too much of it at the time for the use that we had. And, there's just too much of an imbalance that causes much lower prices than we expect. So I don't want to provide a really overly bullish story around this. I just want to kind of set the undertone of what's happened. In the last 4 years, we've lost about 20% of the purchasing power of the dollar, right? So we need more dollars to buy the same hard assets than what we would have had with the 2020 dollar. And that's always been the case. But we've been very fortunate to go through 30 years of rather mundane inflation, where we've just gotten accustomed to that 1 to 3% rate rise every year, very stable through that time frame. And then all of a sudden we go through a very, loose fiscal policy coming out of 12 years of loose monetary policy. And then lo and behold, everyone's surprised to see near double-digit inflation, right? It's really not that surprising in hindsight looking at that. But I think that just like some of the biases that we've had coming into, some of these spread changes where spreads have gone way further than people expected, I think the biases are going back to what's a fair price for corn. You can say historically selling $5 corn has always been a very good deal. But, in terms of looking at what the Brazilians have gone through, they had a much bigger move in their currency in the last decade than we had, right? And they're nowhere near the ballpark of what they require for the same price in real as they did 15 years ago. So I think we have to kind of get out of the mindset, that comfortable mindset of working with a stable currency, and remind ourselves that the underlying dollar-denominated assets are changing before our eyes. Gold is hitting, new all-time highs, well above $2,200 an ounce now. I think that's something that we want to just take note of and not be surprised to see wider carries like we're seeing some of these commodities, copper, corn, things that are well supplied, but still maybe a more elevated flat price than what we've been looking at, in our last period of oversupplied time frame, that 2014 through 2018 year. So that was my little rant on it. I just want to remind everyone that I think we're working with a different dollar than we've been accustomed to.
It's interesting though. I mean, if you look at the dollar index, it's still relatively high, strong relative to other currencies, right? I mean, compared to where it was, 75 to 80 back in the 2010 through 12 range, and now it's sitting there at about 100, 105.
Yeah, well, that's house on a bad block, though. I mean, these are all paper currencies. Like gold is just hitting new all-time highs in euro, right? So its purchasing power has gone down because of excess supply of all these currencies.
Right. I guess my point is not just the U.S. dollar. U.S. dollar is relatively strong compared to everybody else. It's just that, to your point, it's the money supply overall. So I just want to it's not the U.S. dollar that's weak. It's just the money supply that's high.
Yes. Yeah. Money, all paper currencies basically.
Right. So I just want to make that distinction.
Yeah, no, that's a good point. It's not the dollar index, and that's something we've been able to do when we have had a stable purchasing power of just localized inflation. We've been able to take a chart of the US dollar and then put an inverse relationship out to a basket of commodities, and you can clearly see that connection. When we would get, relatively strong to other currencies, a lot of times it's because those other currencies were poor. Emerging market currencies have had years of bad outcome. The large euro experiment, they've had a lot of fluctuation with the value of the euro. So at different times, it's more about them losing or gaining purchasing power against the stable dollar. And then we're seeing that on that inverse of that long-term chart for the first time in a long time. That's what my point is about, we've been really lucky and fortunate to have a stable dollar for 30 years. Now to come in toward double-digit inflation for the world's reserve currency, I think that's, and I could be wrong on this, but I think that's something the market might not have fully priced in for all of the market participants that are working within it. We'll see.
Yeah, I mean, to your point, like if you look at, maybe we can show it next time, but if you just look at the dollar index versus gold, for example, it's totally counter to what's happened over 20, 30 years. So I guess I was also agreeing, you have this really strong dollar index and gold's making all-time highs, right? Usually you would see gold, probably closer to 800 or 750 or something with a strong dollar move like this.
Yep.
Over history. But now they've been going the same direction for the past couple of years.
100%.
So what's the first thing? I mean, nobody's got a crystal ball, but what's the first thing in our industry that kind of resets itself, as we go forward? If we're talking about potentially a new pricing environment and, what has to reset itself first, right? Because there's a disconnect right now between costs and production and, and certainly price. Yeah.
Take a micro example, right? We just had a acreage report that showed that people wanted to plant less acres than they did last year. And it could be associated to lower flat price versus higher cost of production, right? That's my opinion, is why we saw that. It wasn't a total surprise to see less acres overall. So, your areas that, fall out of profitability faster, I think you still need to command enough of a financial incentive to produce grain globally. I know it's a lot different metrics for Ukraine and for South America than the U.S. grower, but globally, I think you still need to provide, an economics of where both buyers and sellers can make money consistently enough, right? And I know that there's always going to be periods where you get into oversupply, and one of those two parties is going to suffer, or the other. And that's what I think we're going into right now, and it could stay there. But, you go back to, well, how do we get land costs down or, seed costs down in the U.S. to make $4 corn profitable again at rising trendline yields? I think that's going to be a difficult task. So, is it that we are going to go to $4 corn and we need to see land values come down rather significantly, rent values come down? Well, we go back to that argument. It's like, why are all these institutions and high net worth individuals buying up large swaths of land? It's for inflation coverage, right? It comes right back down to the almighty dollar. And that's why I don't think we can point to the last 20 years of lows in corn, for example, in the lower threes and say, okay, well, that's where we need to go to in an oversupply situation. I think that's a much harder argument to make after what we just went through the last 4 or 5 years of currency changes.
Yeah. Tom makes a good point too. I mean, is it a reset on tractor prices and some of these, pieces of equipment that are, $1 million plus tractors that, is that sustainable long term, Justin?
Well,
What's
the
your
only way
thoughts?
you reset anything is by stop paying that price.
Yeah, great point.
Right. So, I mean, you have to stop having people buy $1 million tractors, and, so those things naturally happen. I think if, to Dustin's point, in the short run, anything can happen on price. Right. But when you have a certain high cost production, like it has to get in line to keep that production stable. In the short run, it can be a disaster, right? Like we saw in the 80s or some of these years where it has to force production, out of the market, which I think we've seen a little bit of that, at least the 6 million acres to some degree. A bigger issue, I think, is that, not a bigger issue. Another issue to that is that we're having billions and tens of billions of these subsidies that we're trying to encourage U.S. ag. And we're letting all these loopholes. So we're indirectly, ever since the ethanol boom, really, we're indirectly subsidizing all these other countries to expand. So it's kind of a tough deal. Like this biofuel policy that we've adopted, since, Bush with ethanol, and now we're doing it again with biodiesel and some of these other, I'm sure we'll figure out some way carbon credits, is that we let South America and these other countries also benefit huge from it. And they also have a lower cost of production, lower land values, all those things. So we encourage expansion. We kind of cut our own throats and we subsidize other countries to do it. So that's a bigger thing, but it's continuous. And like, if, to Dustin's point, if these other countries can grow it for much cheaper than us, we're always going to struggle in this scenario, in my opinion.
Mm-hmm. Yeah. Tom brings up another good point. I did see there were a couple of no sales in Iowa last week. And then here again, I just read this morning that, you had a $20,000 plus sale go in Central Illinois. So it's, I don't know that we've really tempered that land deal.
Well, some of that stuff too is just, you're getting some land that's probably freed up the first time in 50 years.
Right.
Some of that is just, you got some rich farmers in the area that they're not going to let that piece go. So, you need to see real value move and then you'll kind of get a trend. But at these interest rates, unless you just have cash, unless you have some money to burn, or unless you're Bill Gates or these guys, they have the money just for inflation hedge and they're looking at a 20 or 30 year horizon. As a farmer buying it, it doesn't really pencil, right now at these, if you were just a brand new farmer and you went out and just bought land and financed it, doesn't pencil. If you blend it in over because you have 10,000 other acres, well, yeah, you can make that argument, but.
Sure. Well, Dustin, you brought up a good point earlier this week, late last week, is that you started to see more long-term deals or people being presented for long-term deals, on the cash rent side. And it's an interesting conundrum because you're trying to forward shadow pricing and margins. And it's like, it's an interesting deal.
Yeah. I mean, if you can create certainty and know that, it's good ground and, you've got, close to $5 corn you can get for, these 25, and you can make money at that, then great. I think it's hard for us when we just saw, average break evens on university data in the lower fives for corn to forecast and say, well, we know exactly that we're going to continue to see costs come down in 2025. I don't know that we know that. Like, going back to the Fed's discussion, we have what is supposed to be an independent Fed, but I think there's still a lot of question around that. The incentives and the politicized. Every single form of government's been politicized. This is supposed to be an independent bank, right? But it's also appointed, by the executive branch. So are we really expecting them to not have some sort of influence on like trying to take very, very little pain? We're not talking about Paul Volcker years anymore, where we did have a 1980s style recession, in large part because interest rates were so high that it made that happen a lot quicker. There was not a way to kind of get past that through a lower rate. We seem to be taking very little pain in the interest rate world without wanting to immediately call for cuts. And we're seeing U.S. senators, representatives calling for it. A lot of political pressure, not just from the executive branch, calling for easy monetary policy. If we can't, as a country, take any pain, on the economic side because of slightly higher rates and we go right back into a zero rate policy, that's going to be a problematic for the currency. And I think that's what gold's telling us right now. So I don't want to make any calls for what 2025 cost reduction is going to be yet, because we could very well go into another situation where we start aggressively cutting over the next year. And then we go into that with another need for 550 corn for a break even for that next year.
Isn't it really a rock and a hard place? And we've talked about this for a while, with the debt where it is now, high interest rates are just killing debt service for the country, so they're kind of stuck. It's this whole like give money to everybody, print money for everything, bail everybody out, dollars. And then you get in a situation like this, like, what do? They can't really do their job. I mean, they can't go to 20% interest rates because they go broke.
Yeah, be a
without printing more money. So it's kind of like it's a tough spot.
Right. But it would I don't think anyone disagrees. If you were to go right back down to a really low interest rate right now, that might be too early. There's
100%. I'm just saying that it's also hard because if it starts going back up, I don't know that they have the tools to really go to 10, 12% without cutting their own throat.
We are in a weak position, right? U.S. debt is off the chart. We are in a very weak position. And that's why I think, getting back out of the mindset of being so comfortable that we have a stable currency is that rock and a hard place could cause some very, very, very big differences over the next couple of years.
Right.
So.
Yeah, it's like legging on a spread, right? If you just go sell a whole bunch of corn at a certain price because you think the other half of that equation, your cost equation, is going to be Y, it can be dangerous.
Right. It's absolutely a bet in a way, right? You can't say that forward hedging 2025 corn without knowing your cost is not somewhat of a bet.
Right.
Because, I don't think it's necessarily a bad bet always, because you have the next year, you have 2026 that's going to be going up in value.
Right.
It is a bet either way because it's not known.
Yeah. It's same as buying expensive farmland saying, I bet corn goes higher.
Yeah.
It's the exact same thing. So.
Yep.
Oh, very good, guys. We just came into the open here. We got May corns down 3/4, 431. May soybeans are down 7 1/4, 1175 is the last, and May Chicago wheat's down 1 3/4 at 554. Every day that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. It was a great conversation there this morning, guys. Tom, thanks for the input, and we will be back with you tomorrow morning. Hope everybody has a great day. We'll talk to you soon.
Thanks, Dan.